Hey guys, welcome back to another video. So today I am starting that playlist that a lot of you guys have been commenting that I should start, and that's on value investing. I know a lot of people have asked I know a lot of people have also asked about more option strategies, and I promise those videos are coming, although I did want to pump this one out just to get the ball rolling on this new playlist. Today, I'm just showing you guys what value investing kind of is, just like a brief overview. I'm going to go over one topic in depth, although there is 6 specific topics that I've laid out that I want to make a video on and go in depth on every single one so you get the full understanding. And yeah. Just a disclaimer, this is just for entertainment purposes. I am in no means giving you any financial advice, so just saying. What is value investing? The simplest way that I can tell you what value investing is buying securities when they're undervalued through fundamental analysis. That's as simple as I can put it. Basically, you are buying companies that are undervalued. And I think my head's in the way right now, but if you can see on screen, there is a graph that says share price, and then on the x-axis it says time. And as you can see, the black line says the market price, and the red line is intrinsic value. Now, a company has an intrinsic value. The company is worth a specific amount, technically, not really, that you are going to put on the company. Whereas the market price is basically a voting machine where if more people buy it, the price will go up. If more people are selling it, the price will go down. But there is not necessarily a direct correlation with the value. Like, it's not balanced. Yes, the market price can be the value, and a lot of the times it does swing similarly. It's not exactly accurate, okay? So there's discrepancies. The market price or the per share price might be different than what you value the company on. Your specific value that you put on the company might be different than another investor's, and that doesn't mean that you're wrong, and that doesn't mean that you're right or they're wrong and they're right, but that's just what you value the company on. So simple terms, let's say we have company ABC, and you do all your fundamental analysis, you learn from this playlist, and you apply it to doing the research and doing your due diligence, and you believe that the company is worth $100 per share. And if the company is worth $65 per share, it's not rocket science. You just did all that research to figure out that it should be worth $100 per share. So you buy it at 65, and then you write it up until it is 100, and then you make the margin in between. Now, we're going to go more in depth on how much margin there should be in between, the risk versus reward ratios that you want to be looking for. But that's just a generalization and trying to get your head around it. So the golden law, don't lose money. And I know that sounds really cliche and really stupid, although as you can see from the chart right above my head, the percent loss versus the percent gain. So if you lose money, obviously you have to make a higher return to break even. So if you lose 5%, you have to make 5.3%. And that gets more and more amplified as you lose more money. As you can see, as we go down to 50% loss, now you have to make 100% on the current on the value of your portfolio just to break even. It is critical that you don't put yourself in a more of a disadvantaged position to make money and basically get wealthy. And the whole idea of investing is basically to increase your wealth. And if you're putting yourself farther behind the start line, it's just making it harder and harder for you, and it's not logical. I mentioned that I want to break it down into 6 videos going in depth on each individual one. Today I'm just going to be introducing them: rational, understand, love, event, reduce, and story. And I'm just going to give you a brief little understanding. Rational, you got to think rational in the markets. You have to think logically, and you have to think out of knowledge, not emotion. Understand, you need to fully understand the business, their business model, who their competitors are. Basically understand what makes that business special. Love, you have to love the business, what they do, because you want to be voting for something that you support. Your dollars are voting for that company. An event, put this company on sale, because if there is no event or no little mishap, the company shouldn't be on sale. Like, typically there has to be an event to affect the current share price, to drop it, to make it a buy. Reduce, basically you can reduce your cost basis by dividends, stock buybacks, and other strategies. Basically, they'll pay you and give you more equity to then furthermore get more equity. Story, you want to basically invert your story and be a devil's advocate and attack your own position. This way, you can see if your standpoint is strong, weak, and can basically you are stress testing your thesis. So today I'm just going to break down rational, and first things first, you want to buy into fear and you want to sell greed. We've seen this in the past, and we will most likely see it in the future, although that's a whole nother conversation. Buy into fear. Basically, when the stock market is dropping, there's a lot of fear in the air. People are scared. People are losing money. People are losing their homes, their shirts off their back, their retirement. They are scared. So they sell, get cash because they want to be cash heavy. They don't know what's coming at them, and they don't want these volatile investments. That's when you want to be buying, because if the share prices are plummeting, that means that it's just cheaper for you to get these companies at a better price. Think about it like this. If you go to the store to buy chicken, okay, typically it's a $5 chicken. Let's say you go and it's a $2.50 chicken. What do? It's not rocket science. You buy more. That's what you do. Same thing with stocks, okay? If the price goes down and you like the company, you buy more. You don't sell. Selling is dumb in that sense. You want to sell the greed, though. When people are buying irrationally, when people are not fundamentally breaking down companies, and when the share price is way overinflated on what you believe the company is valued at or should be valued at, that's when you start to collect your profits. You sell, you get out of that position, and maybe you move it into another great value investing stock that you like. I touched upon this earlier. You don't want to invest out of emotion. You want to invest with knowledge. And that's why and the reason why I say this is because the market doesn't care about you. It doesn't care about your emotions. It doesn't care how you feel. It doesn't care about any of that. What it does care about is logic, rationale, and just money, okay? If a company is making more money, the share price theoretically should go up if it's profiting more money. So you got to think logically. You cannot think out of emotion. Just because you think the company is cool, even though they are sinking farther and farther into debt, and it's not good debt, it's bad debt, there's issues. So you got to think logically. Moving on to low risk, high reward opportunities. Now the reason why I say this is because you want to make sure that you manage your risk properly. That's the key to this entire thing. If you can manage your risk, if you make sure that your money doesn't go down, there's only one way up. And I know that sounds stupid, but I'll get more into that and how to make sure that your investments don't go down. Now, the best way I can kind of metaphorically explain this is imagine you have $100 in your pocket. Would you risk all $100 to make $2? No, because you are risking a lot for getting a little. If you risk $2 to get $100, that's a much better risk to reward ratio. If you lose the $2, yes, it stinks, but you only lost $2 and you had the opportunity to get $100. So as you can see there, you want to focus on those low risk, high reward opportunities that will arise. The market is up and down. It doesn't know what it's doing. It's bipolar, okay? The market, through the resources that traders and investors have nowadays, is getting more and more volatile because you can update yourself on the ticker symbols and on the current quote every single second of the day. And that can be a very good thing because you can get in and out of trades and investments, and people in the past have not been able to, such as like the 60s and stuff. It was a little bit more of a process, where now you can get in and out of a position just like that, which is very good, although it makes people typically buy and sell irrationally and not think about their investments. So you have to understand that the market is up and down, and you have to think rationally through that, okay? And I know I'm kind of running through all this, although I think you guys will just get a brief understanding, and I hope you guys go and read other books. There is limitless resources out there, videos you can watch on YouTube, books you can read, articles, etc. Go to talk shows, you name it, there is something out there. The last thing that I want to leave you with today is that value investing, the icon of this, is basically, his name is Benjamin Graham, and he is considered the father of value investing, and the prodigy to that man is Warren Buffett, the investor, the guy who's running Berkshire Hathaway. And basically, all of this is modeled after what they have done, how they've cultivated their strategies to approaching the market. So read up on them if you want to get more knowledge on value investing. Now, if you like this kind of content, please like and subscribe. It really helps out my channel. I'm trying to make this kind of a full-time job in the future. I think that would be really cool. And hopefully you guys found value out of this. And of course, subscribe. Hit that bell notification so then when the next upload comes out, you'll be notified. And until then, see ya and good luck in the markets.